Hey, what is going on, Bulls and Bears? You're back with another dose of economic reality. Wow, it's Friday. It is March 10th, 2023. We have a bank failure. So things are starting to escalate pretty much how we predicted. The spring going into the summer, I said we're going to start to see a lot of things unfold, a lot of things happening. This is the largest bank failure since the financial crisis, and we're going to get more into that here. First of all, the markets are down today. But even before this announcement came out, the markets were down because of the mixed data on jobs, right? So we're going to talk about that also a little bit later. But let's talk about this. This is Silicon Valley Bank. It is the 16th largest bank in the United States. Now, a lot of the stresses from this bank are resulted from, or as a result of, a lot of the layoffs in the tech industry, of course, Silicon Valley. But let's get more into this here and talk about what's happening and what we may be seeing headed down the road here, what's in the cards. So there's a couple things happening here. One, we have basically what's a run on the bank. FDIC shut down Silicon Valley Bank after it failed to raise fresh capital and stem deposit outflows. That's people taking their money out of the bank. And most of us know here, I hope you should know if you've been on this channel, that banks are leveraged to the hilt, right? So they've been deregulated. There's no reserve requirement. And this is the result. So now they're not going to have enough physical cash for people to come and take their money out, people that actually want physical cash. And that's the problem when you have this system where most of the money is digital. It's about 90% of the money now in circulation is actually digits on a screen and not physical paper and coins. All right. So this thing could get a lot worse than what began back in 2008. The question we always had was which banks are going to be allowed to fail, which ones are not. So obviously this one was not allowed, or was allowed to fail rather, because it was taken over. So it's going to be liquidated as far as we could see. Here's what Janet Yellen had to say, the Treasury Secretary. Yellen said, quote, "There are recent developments that concern a few banks that I'm monitoring very carefully, and when banks experience financial loss, it is and should be a matter of concern," she told lawmakers. Now, if she was closely monitoring the banks, why was this allowed to happen? Why are banks allowed to loan out so much money compared to the amount of money they have in deposits, right? Well, we know why, because that is how you keep a failing economy looking like it's functional. You keep people borrowing money, go further into debt, as we all know, buying things they can't afford to buy. If you were to take away the loans out of the picture, you would see car prices crash by about, I'd say about 70%. You would see home prices crash by about probably close to that, 70, even 80%, even worse in housing. This is all propped up on leverage, debt, lending, and spending, and pretending that everything is good. And now we have bank failures. Now there's more happening besides just this one bank that the FDIC took over. And we'll get into that here in a minute. But let's talk about FDIC. FDIC, we know they do not have enough money to cover most of the loans. They have actually a very small fraction of all the, I shouldn't say loans, rather deposits. FDIC has a very small fraction of the total number of deposits that are in the banking institution. So they're not going to be able to make everyone whole again if we see a systemic collapse, meaning a lot of banks or all the banks. The bank had $209 billion in assets and $175.4 billion in deposits. The FDIC, which is the backstop or supposed backstop, they say they're going to have insured depositors have their funds no later than Monday morning. So this is a quick solvent from FDIC for these particular depositors. Will they be able to do this to all of the people that are going to lose their money for future bank losses? It's very unlikely, unless we just borrow the money and add it to the national debt to give these people their deposits back, right? That's a possibility, and it would be unprecedented if that happened. Well, not technically not, because the other things that happen also ended up getting added to the debt anyways. But as far as a swift resolving of these people getting their money back, and they're saying Monday, that's pretty quick. That could be a possibility, even if the FDIC does not have the money. It could be an executive order or something like that that gets passed if this thing continues to snowball out of control. Now, shares of the parent company of this bank, SVB, were halted because of the crashing stock price. The stock crashed by about 60% before trading was halted. For those of you who don't know what halted means, that means You cannot buy or sell the stock. They actually stop all trading in that particular stock to let things settle down, so to speak, because there's panic. A lot of times when it's resumed, the panic will continue. So we could see even a bigger plunge. It may be resumed right now. So we'll see how it ends up. About 60% was at the worst as far as when I checked it here. But let's talk about some other banks, some other things that are happening in the financial system here. All right, we've got other banks also being halted as far as the trading of their stock. We have Signature Bank. They also have some cryptocurrency clients there. We've got FRC, which is First Republic Bank. FRC rather is the ticker. It's called First Republic Bank. Big drop, 40% in their stock there. Western Alliance Bank Corp and PacWest Bank Corp. Trading those banks also has stopped. Now, it doesn't mean that they're going to have to get taken over by the FDIC or by the government in this case. It just means that the panic sort of spread to these other banks and into the stocks of these banks. So we'll have to keep an eye on it and see what happens with these other banks. But let's get into this next story here. We have another bank out of California called Silvergate Capital. They voluntarily decided to liquidate their holdings. So essentially, throwing in the towel, they failed. Silvergate was the most shorted company in the stock market Friday as a percentage of the float. The float is the number of stocks that are outstanding. With more than 84% of its shares available for borrowing sold short. So a lot of people were pushing that price down. Silicon Valley Bank and crypto-friendly Signature Bank and other regional banks such as First Horizon Bank, Bank of the Ozarks stood at more modest range of 5 to 6% of their float being sold short. So it looks like some very big traders know what's happening with these banks, and therefore they were shorting the bank. So are we going to see contagion and more bank failures? I think it's very likely. The question will be, again, when it gets to the bigger banks, what's going to happen with the bigger banks, right? They're too big to fail. I think it's almost guaranteed it's going to be bailouts and added on to the national debt as far as I can see. But we'll have to see. It's very interesting, though, that even a bank this big was allowed to fail. And this is the 16th largest bank in the United States, Silicon Valley Bank. Now, let me ask you a couple questions here. One, do you feel confident that lovely Miss Yellen is monitoring the situation or closely watching the situation? And if yes, then why? Because under her watch, we got to this point. And think about this. If banks would give people more money for their deposits instead of the 1-2% that we saw, a fraction of a percent in many cases over the past few years, then they wouldn't have to worry about runs on the banks. They would have plenty of money in deposits. But no, it was the regulators, it was the people like Janet Yellen, the Treasury Secretary. It was all these people in the financial world that allowed this to happen. So it's very interesting. Please let me know what you think down in the comments, right? So this was all easily avoidable. But again, they wanted to give the illusion of economic strength. So banks were deregulated. And this wasn't just over the past few years. This has been going on for a long time. Even the previous administration, the deregulation started actually decades ago. But the big deregulation started in 2020 because of the response to the health crisis. And a lot of those things that were implemented were never reversed because they knew that once you put them in, you can't take them away, because then the economy starts to fail when you take away that extra liquidity, that extra juice, that injection. So that's the way it's going to be. So please let me know what you think down in the comments. Start of a bigger financial crisis 2.0. We've been predicting this for years. The question is, who's going to be allowed to win and who's going to be allowed to fail? All right, folks, we're going to wrap this up here. We'll be back later today with another report. We want to keep an eye on what these banks are going through right now. And we have some other news to cover. Peace, big love, keep stacking. Bye for now.